Welcome to Teague Talks. Today we're sitting down with Michael Lipson, Chairman and CEO of Access Point Financial. Going to talk all things finance. Are interest rates going up or are they going down by the end of the year? I guess that depends on how you see the world, whether you're a politician or an economist. Michael's a brilliant man and a great financier, and I'm dying to hear his insights. So thanks for joining. Michael Lipson, CEO and Chairman of the Board, Access Point Financial, here to talk all things finance. Michael, welcome to the hot seat, sir.
Thank you for having me here.
By the way, great to see you at the conference, which we just had. Thanks for Access Point's support.
That was a tremendous conference you guys put on.
The team busts their tail year round, but having a nice new shiny Signia by Hilton, a nice new hotel, makes you look like geniuses. So
Yes,
we loved it.
It helps.
We loved it. Thanks for being there. So I want to talk about debt. Thanks for joining us. And for everybody listening, I want to talk finance. I'm trying to put Michael here and drill him on what the financial markets look like, right? And what are interest rates and what are debt coverage ratios and all the boring stuff and what are spreads and how are we getting there? Are they going up? What direction are they going? Are they going up and down? Candidly, so that people can make decisions, right? Am I holding? Am I selling? Am I refinancing? Where's the world going? Not that we know, as we just said, it changes dramatically. So I think with that, my tee up is probably just, how's business?
This week, last week, next week. It is, I've been doing this for over 50 years, and I've never seen a time like this. It's just a changing landscape almost every day. So, depending on which side of the coin you're looking at, one side, there's a tremendous amount of capital available. For hospitality especially, and we can get back to that, why of that.
Yep.
And then on the other side, the equity side of the business is really struggling. Am I a seller? Am I a buyer? And so we come out of these conferences and gung ho, we're all going, and then by the time we get to one of the last conferences at the end of the year, wait till next year, kind of thing. So it's been you're reinventing yourself almost every day to be successful, to stay in the game.
So let's dive into that, and maybe I should set the baseline for everybody. You guys are private credit, right?
Right.
So we have our balance sheet lenders, we have CMBS, local banks and SBA and the like, and then private credit. And you guys are in private credit. So typically, I'll define you. I'll let you answer it. Define yourself, but more flexible, more creative, a little more expensive as well. But maybe we can tailor what you want to what the client needs. Is that correct? And you guys have been, not just you, but all private credit has been one of the most active groups out there. Certainly more active than CMBS, more active than balance sheet, I would say today. You agree with all of that?
Yeah, I would say to you that that's slightly changing. I think, again, let's go back to the politics of it. I think the banks have gotten much more leeway and support from the administration and from the regulators. And so the necessity to manage our balance sheet isn't as strong. And so they're capable of doing more than they're used to. Number one. Number two is, to the specific of hospitality, it's in my career, I've never seen where hospitality has become such a favored class.
Yeah, talk about that. Why?
It's just, how many more empty office buildings can you have? How many more retail going to restaurant can you have? We know that there's a big problem in the multifamily side, mostly driven by the capital markets, not by the industry itself, but spreads got too tight, and they blew out when rates moved away, and just the need for affordable housing. So and how much more industrial can you build, right? So all of a sudden, people look around and they say, well, where else can I lend? And oh my God, these hotels, they came back so fast after the COVID because we were sure, hotel industry and travel was dead. Okay, after during COVID, and how the industry came back. So you have almost everybody coming back into the market. They may be picking and choosing where they play, but almost every deal you'll find some fund or some lender that came out of the woodwork and wants to do a hotel loan. Uh,
Well, we love hearing that, right? I mean, we're all hoteliers, so we love the industry, but
yeah,
we
you
are
love
certainly
hearing
we love hearing it. We're not feeling like the
it.
bell of the ball at the moment, though. That is
Yeah,
for sure.
yeah.
So maybe we're the I don't know what it is, but it's nice to hear that outsiders are thinking that we're a good industry now, and we're feeling that. We're feeling the capital flowing in. So maybe we'll talk about equity too, but we're talking about equity cap flows, debt flows. We're seeing there's plenty of debt out there. That is not the problem. You may not love the rates, you may not love the pricing, the terms. We get all that. You never do, but there's plenty of capital out there on debt. I would argue equity as well. What are you seeing?
I agree with you on debt. There's no issue
Yep.
on the debt side. It's not as efficient maybe as multifamily and some of the other products, but so therefore, you get shopped a lot. It's good for mortgage brokers that do hotels. Uh, on the other side, I'm not sure the equity is there, but I'm not sure people are putting it to work. So I still see a big a big break between bid and ask. We're seeing it in historically we would run and is say 50-50, 60-40 refis to acquisitions. Right now we are looking at about 80% of our pipeline is refis.
Yep.
Very few acquisitions.
Why is that? Why do you think?
I think again, I think uh, the banks have been a lot, and banks, the lending community has been more willing to give time to the to owners, and the owners haven't been willing to accept the reality of what their property is worth today. Uh, and the buyers, are not willing to pony up all the cash and buy it at what they view above market pricing.
Yeah, we see that every day, but I'm glad to hear you say it because, again, I agree with that too. A lot of refinances, although we're as busy as we've been on the transaction side, so everyone's trying to sell, and I think the real people selling are not fishing. The fishing
Yeah.
expeditions are kind of done. These are the people that have accepted where they are, and they're like, "Yep,
Yes.
let's just move on," because the alternative seems to be, well, let me refinance and let me hold it. But now you got to hold it for, again, it's not 12 months. It's 2 years, 3 years, something to that. Maybe it's a 3 to 5 time frame, something to that nature. And and that's a different conversation.
Absolutely a different conversation. You can't go back to your partners and say, don't worry, 6-12 months from now, the market will be fine. The reality is if by 26, if you haven't come all the way back from the COVID pandemic, you got a long way to go.
It is funny though that we joke. One, we've been saying this for 3 years now. We're now 4 years, right? It's June of
Yes.
22, when interest rates really went up, is when everything changed, in my opinion.
Right.
And so now it's been four. Oh, next year will be better. Next year will be better. Next year will be better. And then it's not. And oh, by the way, 25, we had self-inflicted wounds, Liberation Day, and government shutdown, and we won't have that again in 26. You're right. We'll have an Iran
Yeah.
war.
Yeah.
Yeah.
Yeah, it's exactly. I've never, I have a poli sci degree and lived most of my life in Washington, D.C., but I've never seen anything as we've had this last year plus. So,
So give me some specifics. Tell me where sort of rates are and where you guys are landed today. I know, we were historically way down, then we ran way up, then we trickled down, which was nice. Now we've moved up again.
yeah, and I think where you are all in, if I may, I think you are at around historical norms.
Yeah, that's
Yeah, so
yep.
the people that say money's too expensive, no, not really. It may have not been as cheap as it was a couple of years ago when it was almost free, but it's in the historical norms. And as that becomes ever present, to sponsors and understanding that they can't hope that rates go back to to 1% or whatever. You are where you are because your deal makes sense. Now, having said that, if you did your deal 5 years ago, when rates were way down, you lost some value based on where interest rates are. I don't think cap rates on hotels moved as dramatically, and I know they didn't. Where in
Right.
the multifamily space, they more than doubled overnight. Okay, as rates moved up. Hotels cap rates stayed around the same, and I'm not sure cap rates is the best way to be looking at hotel values, but nevertheless. So what you've had is, as we start this conversation, is as capitals come in, spreads are tightened.
Right.
So clearly today you're in a historical norm level, okay, where financing is.
For us in down the fairway, we're seeing spreads, so for 350 seems to be the new norm. That's call it an 11 debt coverage to give everybody a down the fairway. And
Yes.
the LTVs are still in that, 60, 65 for most.
Yeah.
And then it changes off of that, right? You want a higher LTV? I should ask you about that. But are you guys doing much of the what I'll call the stretch pieces? So you put a mezz piece with it, and then you're bumping it up
Yeah.
to 75s. And
So the way I describe, so
please,
you described this earlier, as the high cost guys, is we our profile tends to be, first of all, from a brand standpoint, we tend to play with the tier one brands, Hilton, Hyatt, Marriott, of course, and so you're about 90% of our portfolio is those brands, IHG, and then we play a little. I'm a big fan of extended stay, true extended stay, the budget and lower
yep,
product that's come about. But what we look at is we look at the good brands. We look at the sponsorship. Do they have, they got the history. I call it the 5 and 5 rule. It goes back to many years ago. Do they have at least 5 years of experience operating at least 5 hotels? That's sort of my threshold of before I put somebody
makes
down.
sense.
And then so you got good assets, good sponsors, but okay, the big but they've got a story because that they either repositioning the hotel or they're doing a PIP or something has happened in the market, and so there's a but because otherwise they'd be going fixed rate
Right.
with a life company and yes, 65%, yada yada yada, and much more attractive rates. What I offer them is the flexibility. Yes, I'll go to 75% advance rate. I will also look at what a PIP's going to do to a property or what something that's going on in the marketplace, or even a situation where I don't know what a sponsor says, I don't know what I want to do. Okay, I might want to sell. I'm still talking to my partners, or they're still talking to me, and we don't know if we're going to sell or we're going to refinance or what are we going to recapitalize. Because by the way, I got a PIP that's coming down the road, and so we'll come in there and we'll give them a flexible package that allows for an earlier prepayment without asking for their firstborn. We will we'll do things, but fundamentally, it's still got to be a good asset in a market that we like and we see the future there.
Talk to me more about those assets that you like and the markets that you like.
Markets move around. So if we would have had this conversation about a year ago, 18 months ago, we would have been talking about, oh, we're going to Austin because Austin's the best market in the world. Okay. Today, you can buy
Yes.
Austin pretty cheap.
Yes.
The
Yes.
overbuilding in multifamily, the overbuilding in hotels, it's unbelievable. Yeah, we're looking for markets that are stable, strong. We use some technology, quote unquote, that we buy that helps us pick those, grade those markets. Are they growing? Is jobs going to grow, or at least going to be stable? So our portfolio is pretty elastic in a sense that we stretch across from small markets, we're on smaller deals to, where, we've done business in New York City, we've done business in Chicago, we think we understand unions, different cities, so we'll do union deals. We've got everything in our portfolio from courtyards to ACs to Hilton Garden Inns, Hiltons, Embassy Suites a lot. And we've done some super luxury. We did for a client We did the Beekman, which is a Thompson hotel. We've got flexible capital available to us, so we can do a $200 million deal.
All right, let's talk about the future. Where are we going? I want to know end of year rates, your bet. Are rates up or rates down? And I'll, you know what? I'll hedge it. I just literally before this, I hung up a phone call. So my bet would have been down. However, that they'll be lower than they are today. Not a lot because I think we're in a historic norm, but I just think they bumped up a little from the war. And I think you might get a new Fed chief in, and he might want to lower some rates. So I think he might lower rates. But I just hung up a phone call with a very smart person who said, no, Teague, they're going to be up higher than they are today by the end of the year. So with that tee up, what's your vote?
Well, so I would tell you the first person who said it was lower, so is looking at the political landscape. Okay. The person you just hung up with,
Yeah.
basically is looking at the economy. And the politics of the economy, not the political. And
Yes.
so it's a hard one. I'm betting, since I'm a poli sci major, I'm betting the rates will be down 25 basis points, but no
Okay.
more. Just because everybody's going to want to, politically they're going to want to get it done, and the administration will be geared to do it.
I'm with you. I'm an optimist or a Pollyanist, one of the two. So but that's my
Yeah,
hope.
yeah,
Better days are coming.
yeah.
Michael, thank you. Thank you Thank you for,
Thank you.
I mean it sincerely. And thanks for doing the deals that we've done together. So I appreciate that too. Thanks for lending the money.
Definitely.
And if there's anything I can do for you, call me.
We will.
I love it.
Take
Thanks,
good
Michael.
care. Bye-bye.